You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, that music means it is time once again for Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as from a little thing we like to call the Options Insider Radio Network. And before we dive into this program, if you haven't had a chance to catch up on all the latest offerings from the network, of course, for those of you who want a little bit more, perhaps basic introduction to the world of options and breaking down some of the different strategies and different things you can do with options in perhaps a little bit more approachable way, using some sports metaphors perhaps, then you guys should check out Options Playbook Radio. It's the newest program on our network. We're doing that with our friends over there at Trade King, and they have a great book called The Options Playbook, where they break down a lot of these strategies in terms of plays, offense, defense, income, protection, that sort of thing. So very interesting stuff. Check it out. Options Playbook Radio. And while you're doing that, be sure to look for our Options Insider Radio Network mobile app, available in your app store of choice. Of course, that's the iOS App Store, the Google Play App Store, even the Amazon Kindle Fire App Store. Yes, we made a version for you Amazon junkies out there as well. Check it out, the Options Insider Radio Network mobile app. You can, of course, instantly stream all of your favorite episodes of Vol Views, over 100 now, quite the archive. You can download your favorites to listen on the subway or on the plane, and of course, you can take advantage of that contact suite to send us instant questions, instant feedback to the hosts while you're listening to a program. Great stuff. Check it out. The Options Insider Radio Network mobile app. I think you're going to like it. And joining me on the program today is a return guest. He liked it so much last time, he wanted to come on again. He is Jared Woodard, the founder of Klineman Financial Group, as well as Condor Options. Jared, welcome back to the program.
Thanks, Mark. I'm really happy to be back.
It seems like it's been a long time since you and I talked, but actually you were on the show very recently. And of course, you and I bumped into each other again at the Risk Management Conference last week, which was interesting stuff as well. We'll get to that in a minute, but first we have to dive into our first segment, the Volatility Review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, I hate that intro because it always makes me have that song bouncing around in my head for the rest of the show. This is, of course, the Volatility Review segment. This is the portion of the program where we break down the week that was. From a vol perspective, we are recording this episode, listeners, on Friday, March 21st, just to give you some frame of reference for what we're talking about here. As we're recording this, most of the major indices essentially unched on the day, a bit of a quiet Friday going into the weekend. Vol coming off a little bit as a result of heading into this weekend with most of the major indices, like I said, hovering around unched. VIX cash unched as well, ran around 14.5 on the day. So, Jared, I know it was a busy week for you as well. You were traveling all over hither and yon to different conferences and whatnot, but in the limited time that you had, what really caught your eye this week from a VIX and a general S&P vol perspective?
Yeah, one thing that's been on my radar is something we've talked about a little bit before, which is just relative strength, a kind of relative bid in VIX and implied vol for equities in general, even while the market's staying up. We saw that again this morning, really. I was looking at the S&P up about 0.5% in early morning trading on Friday, and at the same time, you had really the whole VIX curve, all the futures bid up, 1, 2, even 3 ticks at the same time, which is historically a little bit unusual to see that kind of a strength in a bid for volatility. Granted, it was a Friday. There's geopolitical risks and so on, but that's something that we've just seen happen day after day over the last month or two, where you have stocks up and yet people still want to go out and bid up volatility.
Yeah, we're seeing that right now, actually, with all of the futures bid up yet again today, a dime or more, pretty much across the board. The term structure still looking pretty rich out there as you get farther down the curve into ACH and NOV out there. But yeah, futures catching a little bit of a bid across the board, which is interesting. We talked about that a little bit at the conference last week. Again, we'll get to that. Maybe even before we get to that, I want to touch on what you just said, Jared, because it is interesting in general. You're right. People market rallying, people paying up for some premium. We touched on this a little bit on your last appearance, kind of what tends to result after this situation. When people come in, they bid up some vol across the board. The market tends to perform pretty well afterwards because people, they have their hedge on, for lack of a better word, so they're not as concerned about the day-to-day fluctuations of the marketplace. I don't want to preview our crystal ball too much, but do you think this is the case again? People seem to have their protection on, so they're, let's say, a little bit more inured to the day-to-day shocks of the marketplace?
Yeah, I think that's right. I mean, I think you combine the fact that there's definitely been a bid for some premium. There's that huge VIX trade that went up recently. We can talk about that, but there's a sense that people are hedging some stuff here, and even separately from overall positioning, it's just a historical fact that yeah, these situations where vol goes up when stocks are up has, at the very least, we could say, it's not been a cause for major concern. If anything, on balance, it's been positive. And I think a lot of the catalysts that people were maybe hedging against over the last month or two are kind of rolling off now. And unless we get some really bad economic data, I expect that historical tendency to remain strong.
Well, you mentioned that big trade that went up this week. Listeners, if you were paying attention to any of the media around VIX this week, you probably heard it. We, of course, had it on Insider. Our buddies over there at Bloomberg also profiled it as well, so we'll pull from some of their stuff just to give them a last plug. Our buddy Nikolai heading off to greener pastures, or perhaps in our perspective, darker pastures over there at Bloomberg, leaving the options and the VIX beat. But they wrote up some good stuff before he's leaving about this call spread that went up. It's pretty sizable stuff in VIX this week. We saw the May 22-30 call spread going up about 150,000 times. I don't have the price off the top of my head here, but it was just the levels alone. That represents a fairly substantial premium to what we have going on right now. I'm looking right here at the May future trading around 16.5, 16.40. This trade representing 30-odd% bump off what the futures are pricing in. So this is a seriously aggressive bid here from a vol perspective. What's your take on this upside call spread here, Jared?
Yeah, it does look like a pretty major gamble. I mean, so it's the May contract that you're keying off of for this trade, and I was just looking at the one leg is in May, the others were from May 30, if I had that right. But in any case, for context, that May contract was up above 18 in early February. Obviously, it's going to be a lot more responsive the further time goes on. But to get up to those higher strikes, I think that you really need a really major move, and maybe this trader is has a good feeling, but it's definitely something I'd be inclined to fade. That said, one of the most interesting presentations we saw this week was about the relationship between VIX and SPX premiums over time, and one of the conclusions, one of the takeaways from that talk was that in recent months, actually, VIX calls have been, on balance, in risk-adjusted terms, cheaper than SPX puts, which is something that was absolutely not the case immediately after the financial crisis, and even a year or two after that. And so that's been a big change in the way these are priced. And so, if you're gonna hedge, you want to buy some premium to protect yourself. At the very least, we could say that VIX is probably the better place to look.
This is the time when I wish I had some books open in front of me showing some of the OTC stuff going up, because this to me reeks of someone who blasted out some size Vega OTC and then is putting on this just in case the worst comes to pass here, to hedge some of that upside here in the listed products. Again, we never see that other side. I've referred to it in the past, the OTC, as the dark matter of the volatility trading world, because it kind of tends to cover all the other areas, the fudge factor, if you will. But it is an interesting trade. It could, of course, be going up on its own as well, or against. I didn't see anything going up corresponding in the listed stuff, let's say in the SPX or SPY, that at least corresponded to this directly. It could have gone up a few days before, perhaps a few days after. But it is interesting nonetheless. I would tend to lean towards there's probably some other leg here that we're not seeing. But it could indeed just be someone putting a lot of size on this May future, going on a wild ride before expiration. And that would be a wild ride indeed. That would probably be Ukraine really coming to a dark turn, and a few other things perhaps really spooking the market between now and May expiration on the futures. Some other stuff going on this week. Of course, it was conference week. The last couple of weeks were actually conference weeks down in Florida from a derivatives perspective. We had the RMC conference. We're going to talk about that in a little bit. Also had the big futures industry show. And at that show, SIBO made a bunch of announcements, including of course, the announcement of the VXST options that a lot of listeners of this program are really waiting for. And also the fact that they're finally going to go essentially nonstop trading in the VIX futures. A lot of you guys have been asking for this. Hey, why can't we get a full day of VIX futures trading? And essentially, they're going to finally accommodate you guys. It looks like they're going to start it in mid-June, late June actually, June 22nd. So you guys who've been chomping at the bit for all this stuff, VXST options coming in April 10th, and then the full suite, the full day of VIX futures trading coming on June 22nd. Is this a good development for you, Jared, or is this a bad development? Because your guys are a relatively small shop. I'm guessing this means even less sleep for you now.
Yeah, that's one potential consequence. Although that said, I like the, if I have something that I have to trade at night or early morning because of something going on, it's usually, futures options, and those aren't as liquid in the after hours, and so on balance, this is probably a positive development for me personally, and I think it's probably a good thing overall. This isn't the first move into an hours expansion by the exchange, and it seems like there's been a really positive response so far when they've added more time for trading. It seems like something people that have definitely wanted. So it makes sense in that regard. And I think that as a lot of these international events and other events kind of stick with us, it's still a world where there's a lot of different macro risks and overnight things that can happen. I think it makes sense to have a vol product that's you don't have to wait around for to trade. So on balance, I think it's probably a good thing.
We also cover the broad suite of vol products, not just VIX, even though VIX takes up the lion's share of the oxygen in the space these days. A lot of other stuff cooking, including, of course, what's going on out there in Russell. We touched on Russell. They came on board with the show when we first relaunched back in the beginning of the year. It was the first month or so, really, of that product. And there was some pretty decent open interest, around 3,000 contracts, which were of the first month of a product, is faring pretty well. And it seemed to really correspond with what I like to call that crazy February surge we seem to always see in vol products. They had a ton of open interest going into the Feb expiration. Feb expired, and a lot of that stuff came off, and it hasn't really come back on yet for, I guess, a variety of reasons going on out there in Russell land. It's not like it hasn't been a volatile time since February. It just, for whatever reason, February really seems to resonate with the, like to call them the vol crazies, people who like to load up on crazy upside, not unlike our friend here with the size call spread in VIX, loading up on a lot of crazy upside in vol and kind of just swinging for the fences. And it's an interesting time. So we haven't seen a lot of that come back up. I think there's about 500, 600 contracts open interest right now. Ironically, the RVX seems to kind of be VIX almost condensed, where, we usually talk about heavy call to put ratios in the VIX options. RVX is the extreme of that. It's all calls. There's no interest in the puts whatsoever, which is kind of interesting. Granted, it's a smaller number, but it seems to be, at least for now, the use case out there in Russell vol land is all to the upside. Have you've been watching Russell at all? I know you cover a broad suite of stuff over there at Klineman. What's your take on what's been going on with Russell vol over the past couple of weeks?
Yeah, I was thinking about this late last week, actually. So one of the things I try to pay attention to is correlation within and among equity markets, even at the sector level. And I think that those have been declining, as everyone knows, for quite a while. You're starting to see now even declining correlation that is realized correlation among different major equity sectors. And I could see in the near future some real possibilities for divergence between the equity indexes, some different moves, and then that filtering out into the volatility space that would make Russell versus VIX trades start to look really interesting. If you see, there could be economic reasons for that. If the changes in monetary policy and bank positioning mean that cost of capital really starts to go in different places for different equity sectors, or if you just see a turn in the economic cycle that causes some shifts in consumer preferences. There's a lot of different reasons why we could start to see. Everyone likes to say, sometimes it's a stock picker's market, and while that's always true, I guess this looks like a situation where we're at a point in the economy where we could start to see some really meaningful divergences that would make small versus large cap type themes even more important. And then I think in turn that would drive most likely some really interesting setups for your outlook for volatility in the Russell versus the S&P.
I agree. I've been watching it with a great deal of interest for the last couple of months, and it does seem to pose some interesting opportunities. Of course, there is a key component still missing on the Russell side. That is, of course, the ETP universe that seems to be feeding in and driving so much interesting activity and trading volume on the VIX side. That hasn't really emerged yet. In Russell, of course, it's only been a few months, but I think once that stuff starts to take off, it gives retail even a better point of entree into these products, and they can start using that against the RVX and start feeding into the bigger, quote-unquote, type contract. It might be interesting to see what types of opportunities develop there between the ETPs versus the RVX product itself versus the big VIX product and all the other slew of things that are floating around out there, VXST. There's certainly is no shortage of opportunities on the horizon from a vol and a vol products perspective. Speaking of other vol products, a lot of you guys writing in all the time saying, hey, we love the index vol talk, but can you talk about some of the other categories, other volatility going on in the world? So we're going to accommodate you guys. We try to accommodate all of our listeners here. And certainly the big other story from a vol perspective over the past few months, it has been in the energy realm, and particularly nat gas. I believe you touched on it a little bit last time you were on, Jared. Of course, back then when you came on last time, we seemed to be right in the middle of the peak of the madness. Of course, we saw that big spike in the nat gas futures right around the time of all the Ukraine stuff breaking. I think that was around mid-February. We saw the nat gas futures gapping up to around $5, which was crazy sauce for that product, given the fact that it was one of the more reliable premium sales out there, and then it kind of just blew through all those strikes to the upside pretty aggressively. We've since have seen that taper off a bit. Looks like the front month futures are around 430 or so now. The D's futures pricing in a little bit of a bump to around 450, but nothing crazy. And if you look even farther out beyond that, get into next year, some of the products and the expiration cycles, they're pricing it back down to around $4. So they're apparently saying this is an aberration. I don't know if that's wishful thinking or what. These are all the call writers saying, hey, we need to get it back down below $4. Do you think the kind of the blip, as it were, Jared, is pretty much done and we're kind of seeing the tail end of this? Do you think maybe this is the eye of the storm here and we have maybe another surge to go here in nat gas?
Well, I think in terms of the fundamentals, the story is definitely kind of over. I mean, the weather that was driving a lot of these moves, that part is done. And so now I think the story is more about those longer term shifts in energy plants shifting from coal to nat gas and production, all those longer term trends. And if you look at the options market, I think that the conclusion is the same. So, also for example, like 3-month implied vol in UNG, which is actually a nice. I like to look at the ETF here because it's that constant maturity index versus looking at implied vols on any given futures contract makes analysis a lot more difficult to make longer term comparisons from. But if you look at UNG, the 3-month implied vol there is actually lower than at any point so far this year. It's lower than where it was for most of last year as well. So it's not just that the spike is done, but they've actually pushed down the front of the implied vol curve in the nat gas ETF to very low levels. And the story in crude oil is actually pretty similar. So if you could look at it on a percentile basis to get some normalization there. And I keep stats on that. The 3-month implied vol for both crude oil and nat gas is in the bottom decile for the last 2 years of history. So they're both looking relatively very, very low, in fact, compared to recent history. And that's not true just at 3 months, but at other time horizons as well.
That is surprising. So they've come off the other end of that spike pretty hard. It may be a time to actually scoop some vol out in energy land. It's interesting that you watch UNG. I watch UNG a little bit too. I kind of go back and forth with these commodity ETFs. So many of them are terrible. UNG isn't as terrible as a lot of the other ones out there. There have been some interesting activity of note. You mentioned the vol coming off. We had that spike earlier, and it seems ever since that spike, you're right, it was weather-related. There were also geopolitical and other things that were driving that. But ever since that spike in mid-February, puts have been the order of the day out in UNG. They've dominated calls just about every session. Part of that is just the nature of that UNG product. It's a little bit heavier from a price perspective, but also just in general, it's all puts all the time, which is kind of interesting to see that kind of activity and yet see the vol still coming off. So I guess they might go back to what we talked about earlier. They have their hedges on already, and now they're kind of content. Nat gas can go wherever it will, and they already are set up for that movement. So yeah, see heavy put action in UNG, long-term futures pushing around to the 4 handle again, and vol coming off across the board. A bizarre scenario, I think, to say the least. I think nat gas may merit some further attention here on the Volatility Views program. So there you go, listeners. Hope all you guys who are active out there in the commodities are interesting. Speaking of commodities, we can't really shift away from the commodities without talking about everyone else's favorite commodity product. This is the shiny stuff, the metals. Do you watch the metals a lot, Jared?
I do. I guess I watch them more than I trade them. I like to trade with at least one eye on a fundamental story, and for the industrial metals, it's one thing, but for precious metals anyway, it's so hard to get any real sense of. I don't think there are actually any really major fundamental drivers. Some people feel differently, but I don't trade them that much. But I do watch because there's definitely a lot of sentiment around gold and silver, and of course the industrials give you a clue to demand in emerging markets. So those are all really important.
I think that's probably the sentiment across the board. People tend to watch the metals more than they actually trade them. We just did our futures options roundtable show earlier this week, and one of the things we were talking about was the study coming out of FIA. They do it every year, global derivatives volume. And for all the Sturm und Drang around metals, it seems like every day everyone wants to know about metals. The actual trading volume is pretty nominal compared to other asset classes out there, like the rates or like the equity indices or things like that. So I think a lot of people do the same thing you do, Jared. They watch them, but don't necessarily trade them. Certainly in the precious stuff. Some of the industrial stuff can get a little crazy from a contract spec, copper, and of course the steel rebar stuff, which is lighting up the tape overseas. But that's for another show. But interestingly enough, we did see some movement in the non-shiny stuff this week as well. Copper, of course, the narrative in copper of late has been China, weak China demand, pretty much just driving down the demand for this industrial metal. Depending on the different studies you look at, it, China can account for upwards of 40% of global copper volume. So whither China goes, so goes copper. A lot of people starting to think maybe this endless bearish narrative on copper is starting to be overdone a little bit. It just broke through the 3 handle recently. We're starting to see if some people start to pile in either nice contrasting viewpoints, which makes the market, people piling into some downside for continued downward movement. They think copper is pretty much done. Other people saying, hey, it's time to really catch a bounce out here and bidding up some upside as well. So we're starting to see a little bit of juice coming into those strangles.
Just anecdotally, I've seen some interest from from the contrarian side of things, I was talking with a client recently about about what's going on in copper, and my take was that there's so much vagueness and opacity around the fundamental story. And we all know it's used for financing and is a kind of an input in the shadow banking in China. But other than that, I think it's hard to have a real gauge on what a fair price is and what a good risk premium is actually to put on if you're going to trade the options. And so I could understand wanting to get long vol if you have a really strong view, but for a kind of a contrarian or stat arb or mean reversion type of a trade, I actually probably look somewhere else was kind of my take. It's just such a product that can give you some big whipsaws, and I think it warrants a bit more caution.
Let's wrap up on the precious stuff because everyone loves the shiny stuff. Gold taking it on the chin again this week. A lot of people waiting for the FOMC announcements. Of course, gold taking it on the chin right afterwards. Went from about 1380 in the futures down to about 1335 as we record this today. Again, you say you watch the metals, you don't really trade them a lot, Jared, but what's your take out there in gold? I know a lot of people out there really like to watch gold. We've seen some sharp movements in the precious metals in the last couple of years, and people like to flock into gold and the put wing in particular, it seems like, and they really bid this stuff up to just absurd levels. We've had some recent big down moves in GLD and in the gold futures, obviously, as well, and people bidding up those options at such crazy levels that at the end of the day, it still didn't pay off for them because the move just couldn't make it worthwhile. Are you starting to see shreds of that again in the marketplace, or are people being perhaps a bit more measured when it comes to their protection in gold?
Yeah, I've heard from a lot of traders who caught the rally into from the beginning of this year, and it's kind of did sell off sharply this week, but you're still up a lot on the year if you were long. On the volatility side, it's been interesting. Gold's been the options in gold have been gradually working off the premium that kind of was injected when the trend really shifted. I guess it was early last year, and that premium's really finally come out. I mean, it was kind of a shelf in gold implied vol for a long time that just wouldn't crack, but it has this year, and you've seen the premium get down to levels that are about the bottom third of the last few years of implied vol levels. So they're not radically cheap, the options that is, but they're certainly not expensive at all relative to recent history. So anyone who had a bearish thesis on metals maybe last year or year before that, I think this is probably a decent time to reload on that view from a volatility premium point of view. And like I said, on the other side of things, and there's people out there who have their sort of economic views that want to get them into gold for the long term. And on that stuff, I think that it's actually makes more sense to pay attention to short term sentiment. And on that count, it seems like the sentiment is a lot more mixed now.
All right, good stuff. So there you go, listeners, all of you who wanted a diverse array of asset classes here in the Vol Review. I hope we've accommodated you. If by some chance we missed an asset you like to talk about or would like to hear us talk about here on the program, let us know. A lot of great ways for you guys to do that, including, of course, through the mobile app. And now we're going to keep on rolling right on into our next segment, the Volatility Viewpoint.
It's time to welcome thought leaders from throughout the volatility trading world. It's time for Volatility Viewpoint.
Yet another song that just stays in my head for the rest of the episode whenever we do this show. Find myself humming it to myself in the breaks. All right, welcome to the Vol Viewpoint. This is the portion of the show where we'll bring on a guest from throughout the world of volatility, proceed to pick their brains, or sometimes we'll just dive into an interesting discussion topic as well from the world of volatility. And we're going to do the latter today because Jared and I, like I said, just came back from the big risk management conference down there in Florida. And listeners, if you're not familiar with this conference, it's a biannual event put on by the CBOE, of course, the creator of many of the products we talk about on this program. And they do a couple of things. They bring together a lot of end users of these products, So institutional end users, as well as researchers, as well as some of the more retail-oriented people who want to learn about these products as well. And they talk about all things vol and S&P pretty much for a couple of days, and it's an interesting event. Hopefully, if you had a chance, you couldn't make it down to Florida, you were able to follow along with what we had up there on Options Insider, as well as some tweeting we did from the conference, tweeting out some of the pearls of wisdom that we encountered along the way. But it was an interesting show, and I don't know about you, Jared, but for me, I thought the tone was a little bit different from years past when I've attended the conference in a couple of different ways. I think first off, there seemed to be a different theme to the event. In years past, it was kind of a rah-rah vol, rah-rah VIX. Certainly there was some of that this year just to get the kind of the end users on board with the product. But there seemed to be a lot more of a practical focus as well. I know for a lot of these end users, these are guys who manage funds, and they have clients, they have boards they have to deal with. They have consultants they have to deal with if they're pitching these things to other funds and other advisors. So there still are a lot of barriers to entry from a volatility user's perspective and how they can get other people to kind of sign on board and embrace these products. And that seemed to be a lot of the focus this year, which I thought was kind of interesting. It was how to get the endowments on board, how to get the consultants, who are still a big obstacle to these products, how to get the fund consultants on board with these products. Did you notice that tone as well, that there seemed to be, I hate to say a more practical tone to this year's conference, but certainly a little bit more real world type advice on how to get that kind of stuff done?
Yeah, I noticed that for sure, and I think it was evident even in the panels and sessions that were scheduled. You know, there's a good one from I think a guy from Goldman Sachs had a big presentation on the use of options in the mutual fund industry. There were some of those panels on getting your pension board or other institutional panels to use options. I mean, even one of my favorite sessions was with Manish Deshpande from Barclays, who was talking about flow in VIX ETPs and volatility products. And while that wasn't about sort of bringing people on board, it was definitely about where the demand has been coming from for volatility products and options, and how that's changed those markets over the last few years. So I think that practical angle was definitely there, and probably for the good. I mean, it was a definite focus on what you can do and also who's doing it, and I think that's worth paying attention to.
I'm glad you mentioned Manish, because he made one of the first comments that really kind of caught my eye, and he was talking in his presentation about, you're right, all the who's using these ETPs and things out there and where this flow is coming from, where this demand is coming from. And he made a comment that a lot of the demand coming from these VIX ETPs, which a lot of people have traditionally laid at the feet of retail. I mean, Chris Cole, very famously on this program not too long ago, referred to them as the shoe shine boys who are driving all these VIX ETPs in all these crazy directions. And then Manish comes along and says retail has a little bit of presence in these products, but it's really the RIAs and the family offices that are driving a lot of these ETPs, in particular VXX and a few other ones. And that one struck me as a little odd, and maybe it did you as well, Jared, because the only other place I've seen mention that topic is the SIBO itself, and I would believe they're pulling from Manish's work when they say that. So I've talked to a lot of other people in this space, even at the conference last week. I haven't really seen that anecdotally and empirically myself from some of the flows that I've analyzed. Of course, we always talk to people who look at this stuff from a variety of different perspectives as well, talking to RIAs, sub-advising with different RIAs, working with that audience. We do our own advisors option show here. I have to say, everything I've seen so far empirically and indeed anecdotally doesn't really seem to support that. I can't really say off the top of my head there are a lot of big RIA firms or advisors that I've seen that are very, very active in the volatility space. Maybe you've seen some data that disagrees with that. What was your take on that comment there, Jared?
Yeah, I guess it's down to what data you get from in-house surveys and peers and people that you know. I don't have any special data collection or haven't really seen any other research that would lean one way or the other. I know anecdotally, I have a fair number of friends who are registered RIAs who will use options in some cases, but especially the volatility ETPs when they want to hedge or they want to even in some cases trade for kind of an alpha speculative angle. But it's hard to say whether that's what the size is there. And I guess it's a question that you just have to kind of do a big survey on. my sense is that there's a very strong demand from hedge funds and from a lot of individual traders. It would be kind of weird, I guess, if everyone was kind of in the pool except for the RIAs. But at the same time, I take your point that it's hard to know exactly what the size is for these things.
I suppose there could be an audience out there that is using these products as a surrogate for using options instead, because they may have restrictions on options, or perhaps they're leery of options. But I would think that just embracing these products would require at least some facility with the derivatives world in general, because you have to kind of know what you're getting into to embrace these products. And we haven't seen a lot of that in the world of RIAs. And granted, we looked quite a bit when we were doing our advisor option show for advisor firms that actually use options. And there's a surprisingly small ecosystem of them out there. So to say that there's this large group of RIAs that are using VIX ETPs kind of strikes me as odd. But, I think we'll have to bring Manish on the show and let him discuss it for himself and see where he gets that data from. And then we'll challenge him physically here on the program. No, I'm just kidding. He seems like a great guy. But that was interesting stuff. Of course, there's a lot of interesting stuff really down there. That's one of the reasons I like going to this conference. A lot of other conferences we go to are very much on the networking side of the fence, but there's a lot of content here at RMC, which is kind of interesting. Getting back to the practical tip as well with the consultants and whatnot, there was a whole panel there with the institutional consultants and advisors talking about a variety of different things, and also a panel about with some of the end users, the guys who create some of these funds, talking about different historical performance of options related strategies. And that was interesting, I think, for some of the more newcomers to the group and to the conference to kind of learn how these things have performed over time. But one of the things that drove me crazy on that session, I think there was a guy there from Horizons, but they kept talking about put selling and how great put selling was in terms of generating income for a return, and how it's great money that you could scoop up from the marketplace. And they kept talking about BXM versus the put right index, which listeners of this show know we've gone into extensively several times now on this program. First with Russell Rhodes about a month and a half ago, and then we brought Jason on, who's actually the co-creator of that index, to discuss exactly why puts tends to outperform BXM. And as it turned out, it gets into some of the fundamental minutia of the way that index was designed and the quotations versus what the surface impression you might have from that is that, the puts have the higher level of inflated vol than the calls do, when of course they're both at the money. They're both essentially the same level of implied volatility. So that shouldn't really account for anything. And yet on that panel, they kept saying that it was because of the puts have this higher level of volatility. That's why put right is such a better product for you than BXM. And I wanted to stand up, Jared, in the middle of that session and just shout, no, listen to our show from about a few weeks ago. And it will set all of you straight. But I restrained myself. You'll be happy to know. Did you catch that session?
I did. I think I might have missed the comments you're referring to. But I do remember some discussion of virtues of put selling, and that came up again in one of my favorite sessions, which I guess I mentioned at the top, but it was a talk about the features of the VIX option market and what kind of pricing goes into a VIX option, and there was some empirical work on the pricing of VIX calls versus SPX puts, or just VIX options and SPX options in general, in an arbitrage framework over the last several years. And I thought that was really fascinating, because they showed that in the years after the financial crisis, that VIX options were, again, in risk-adjusted terms, more expensive than SPX puts. There was kind of a flat period performance-wise where the two were priced roughly equally. And then in recent months, it looked like that VIX calls were meaningfully cheaper than SPX puts. And so to see that change over time, it was really interesting. It's interesting to think about some of the reasons why that might be the case. And that, I guess that added a lot more color to the usual VIX versus SPX discussion that we usually tend to have.
Yeah, usually that conference is pretty much littered with VIX versus SPX, and the tone is usually trying to find some way to make VIX relevant in that discussion, because it usually loses out from a pure hedging perspective. I've seen a few interesting stuff, including from our friend over there at Merrill, about some VIX calendars that it seemed to be one of the few strategies that actually had any sort of relevance. Of course, in this environment with whipsawing all over the place with VIX, that probably isn't the best strategy either. But yeah, we've seen a lot of people go to a lot of contorted lengths to make VIX seem like a decent hedge versus SPX. It seemed like that narrative had shifted a little bit this year as well, where people weren't beating that drum as much. And people also in the past have really extolled the virtues of hedging your tail risk, quote unquote, at this event. And this year it seemed to have a bit of a dim view on tail risk as well, which I thought was kind of interesting. In fact, Ewan Sinclair, another guest on this program in the past, was on a panel, and he made a comment along the lines of, people are spending 10 to 15% a month to hedge against a once every 100-year event. And it seemed to put a lot of that tail risk talk in perspective when he said that. I thought that was kind of interesting because you don't really hear that kind of frank stuff at this type of event that often, where people are usually, like I said, extolling SPX for that very purpose, to hedge against that crazy once in 100 years type of event that people like our friend Taleb have been beating the drum for so long. So to see people kind of pushing back against that a little bit was kind of refreshing to me as well.
Yeah, I think I noticed the same thing. I think you're right. There was less of a focus on sort of tail risk strategies and hedging strategies, and a little bit more color on some of the different, let's not say speculative, but different, alpha generation and investment theses that you could use, or that you might base an options strategy on. And so, I mean, I think that's all for the good. We've covered a lot of hedging work in the industry in recent years. So to be looking at ways to use options to improve returns, I think is probably just as much a function of the mood overall in the investing world as anything else.
Yeah, when even Mr. Black Swan himself is riding the wings, and maybe tail risk is a bit overdone. We talked about the put writing before on that panel. One other mention I saw from that panel that kind of caught my eye and I wanted to discuss with you here on the show was that they were talking about, again, the put right versus BXM and how to structure your put rights to outperform and things like that. And I think it was a guy from Horizons who kept mentioning in their put writing portfolios, they tend to focus their liquidity not on the front end of the theta curve there, where a lot of people like to do it, not in the weeklies or even in the monthlies, but they tend to go 60 to even 90 days out, because he said, at least from his research, that that's where he sees a lot of the institutions buying their protection, and therefore they are bidding up that put wing. And for him, at least, it seems to merit rolling your rights out 90 days even to try to capture that premium. Did you hear that, and did that resonate with you as well?
It did resonate with me. This is something that I've been looking at this year, and you can actually combine that comment with one or two other things to arrive at, I think, a nice view. In that flow talk we were talking about earlier from Manish Deshpande at Barclays, he mentioned one of his points was that the shape of the VIX term structure in recent years has been, especially over the last year, a little bit more of a U rather than just a curved slope, as the short-term futures and short-term SPX options have been a bit up and have reacted very dynamically to any kind of market risk event. At the same time, the middle of the curve, the belly, has been kind of depressed, meaning that owning those midterm futures, or owning let's say quarterly 3-month options hasn't given you quite as much bang for your buck. As a result, from the short volatility side, anyone who likes to sell options or sell vol, the risk-adjusted returns to different short strategies have been much better for people selling premium in the middle part of the curve over the last year or two. That's something I've seen empirically. I wrote something up on this earlier this year. And so to hear kind of similar comments from some of these guys was some nice confirmation. And I think it's pretty intuitive as well. If I imagine an archetypal investor who wants to hedge an equity portfolio, I think the message has kind of gotten out that owning 1 and 2 month options and just buying puts and rolling them constantly can be a bit expensive. If I was just not interested in active trading but just wanted a simple hedge, I'd probably be more inclined to look out to a quarterly basis, maybe put on a collar with the 3-month expiration. So I mean, if that's true, that story is pretty intuitive to me.
Yeah, you're right. From an end user perspective, it makes a lot of sense to want to buy puts out there. Like I said, I haven't seen all the data en masse to say that is indeed the case. It sounds like you have seen that data, which is kind of interesting. So you're saying forget the weeklies, 3 months is where the action is at from a put right perspective.
I think, I mean, at least empirically, selling the stuff that's 3-4 months out has seemed to work better from a short vol point of view. But I think that that brings up another interesting point that is worth thinking about for really anyone who's trading options and vol products, which is that so much of the attention in recent years has been on essentially short Vega trades, whether it's VIX futures and ETPs or options trades that are dominated by the Vega component. With VIX and implied vols in equities at nominally low, I mean, they're just at low levels in numerical terms. There's not as much juice in terms of the downside to Vega. You're left with essentially rolling down the curve if you're going to trade VIX futures or longer dated implied vols. And then if you're trading in shorter term options, it's obviously a time and sort of short gamma type of a focus. And sometimes those two differences kind of get mashed together, I think, when we're talking about a lot of different strategies. And right now, at least in this kind of environment, I feel like from an option seller point of view, it's probably probably the gamma, short gamma component that's going to drive returns for good or ill, more so than the implied vol sensitivity.
Yeah, I was going to mention that as well. This is probably an environment where that approach might be seen a little bit more favorably by some of the people who traditionally and routinely blast out the weeklies, because you're right, this is not an environment where short gamma is essentially highly conducive to good returns. It's a dangerous time to be blasting out a lot of gamma, so maybe people who are kind of looking at that and saying, I want to take a step back, maybe they could be enticed to roll out to that 60 to 90 day period where in the past they've been so glued to the weeklies they would never even look at it.
Yeah, and by the same token, when we're assessing the value of different volatility strategies, if it turns out that let's say the September VIX futures just kind of chop around for a month or two without really decaying, I think it's worth thinking through why that's the case. And part of the reason there is just that when they're at, let's say, 18, there's not as much room for the downside. And that's actually also one of the reasons why that was one of the arguments, I think, why VIX calls were looking relatively more attractive here in risk-adjusted terms versus SPX puts, is because there's just not that much more room for volatility to go down before it just kind of floors out. And so that makes the risk and return a little bit more attractive if you're looking to hedge a risk.
All right, Jared, you and I can probably gas on about this conference for quite a long time, but we have to keep rolling into the final segment of our show. Listeners, if you want to learn more about all the different stuff that went on at the conference, check out cboermc.com. That's where they have the agenda there. They're supposed to be posting the presentations. I don't see them there yet, but hopefully they'll have those up so you could follow along and see all the stuff that Jared and I did, and send us your questions and comments about that, because we'd love to hear what you have to say about all that interesting research going on down there. But now it's time to keep on rolling into our final segment, the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, everybody, welcome to the crystal ball. This is, of course, the portion of the show where we peer ahead into the murky future and attempt to divine what the volatility gods, all one of them at least, hold in store for us. Let's start off, Jared. You know the drill. You've been on the show before now, so you know how this works. Let's start off in our base camp, our bailiwick, if you will, the world of S&P 500 volatility, a.k.a. the VIX. What's your take? What do you think we're going to be seeing for the week to come from a VIX S&P vol perspective?
Well, I see that S&P realized vol at a 1 month look back is still below 10%, as it has been for a while, despite a few moves intraday quite large. On a close to close basis anyway, it's below 10%. At the same time with VIX, 14.5 or a little bit above that, and the futures at 1580 plus out the curve, it still looks a little bit expensive to me. But like I was saying before, you have to ask whether high premium, you want to monetize that with a short Vega exposure or being short gamma, or what weighting between those two approaches. And in this kind of situation, I could see the premium staying at relatively higher levels further out the curve for quite some time. It just seems like traders have been bidding up vol and might continue to do so. So for the week ahead, I'm sticking with a kind of a short gamma bias. At least the time component is a little bit reliable. And if that means another 10 cents off the April futures, then I can take that.
Interesting, a short gamma bias, given all that's going on out there these days. You play with fire, sir.
You have to take risks somewhere.
Interesting. We'll see if our friend out there in the May call spread has his way. These futures could be off to the races sometime in the near future. But you're right, it is looking a little rich. Perhaps not any time, at least for the immediate week to come. We also touched on some of the other asset classes. Nat gas, vol, obviously coming off quite a bit, looking a little cheap. So perhaps it's time to scoop some out there if you think the vol is going to come back anytime soon out there in nat gas land. The weather and everything else is kind of past, but you still have that one little wild card out there of what is going on in the Ukraine and Russia. Again, big nat gas producing and consuming part of the world. So that might be kind of interesting for how that impacts into the marketplace. So if you have a viewpoint on that, it might not be a bad time to take a relatively cheap, anyway, flyer on what's going on out there from a vol perspective in nat gas land. Any other products really floating your boat right now? Any of the VIX ETPs, any of the others, the metals or other, that where you really want to take a firm stand on some vol right now? Jared, the floor is yours.
Yeah, I mean, so we were talking about short versus medium term VIX things earlier, and I think that if you want to trade the curve consistent with those views from before, the ETP is ZIV, which targets the medium part of the VIX curve and has a short bias, so it gains in value as those futures decline. And it's not an investment recommendation as such, but that's the product to do if you want to follow that kind of a thesis. One thing that we didn't get to earlier was the reaction in rates markets this week. A lot of investors were, I think, looking for not as much dynamism out of the Fed meeting, and so you saw a big sell-off in Eurodollar futures this week. I think a lot of people were positioned sort of casually long, and so they spiked down pretty hard. So I was looking at like the December 2015 contract, for example, and so that that's not something where I know a lot of options traders always trade, but just the interest rates market in general has been implied vols have been so low there for so long that if these big reactions in short-term interest rate products become a little bit more common, I could see rates volatility starting to pick up and the options on those products move accordingly. I mean, I look at TLT vol, for example. Everyone knows that TLT ETF, and I look at that just because there's so much volume there, and it's a similar story where you have implied vol that's been extremely low for a long time, and if we are at a kind of a secular shift in the bond market with that secular bull turning to a secular bear, I think there's a lot of easy places to pick up premium in the interest rate space.
You're right. There has been just a remarkable resurgence in the interest rate space over the past year. In fact, looking at those numbers from 2013, probably the biggest surprise narrative, I think, to everyone from a global derivatives perspective was just the rebirth of the interest rate suite across the board, the 10-year, the 5-year, the Eurodollars, you name it. All of them just lighting up the tape. Mid-curve options doing especially well out there in Eurodollar land. So if that narrative continues into 2014, and so far it seems like it certainly has, you're right. I think that will be a much more relevant space for the listeners of this program, the people in the options realm and the volatility realm, where in years past there really wasn't a hell of a lot of options vol, and there wasn't a lot of volatility in general going on out there in those products to really entice them into those. But now, different story in fixed income land across the board. And TLT, you're right, we touched on it a little bit here on the past, but it's an interesting one from an ETF perspective. I know a lot of our retail listeners like to use that as their treasury proxy, for lack of a better word. And it's interesting to see what's been going on out there as well from a volume perspective. TLT is lighting it up with about 50,000 contracts ADV now, which is impressive for that name from an options perspective. So retail and institutional starting to find their way back to the fixed income space, which is interesting, and probably another product we'll have to add to the long list of new products we cover here on Volatility Views. So thanks for giving us more work, Jared.
You're welcome.
All right, and before we can add any more products, I should put a lid on this episode here of Volatility Views. I know a lot of you guys wrote in with listener mail. Keep it coming. We just didn't have a chance to get to it today. A lot of other stuff to talk about, as you might imagine, but don't worry, we'll get to it on a future episode. And before we go, Jared, I know you have a lot of irons in the fire over there at Condor and at Klineman. Why don't you go ahead and give our listeners a bit of an overview of what you're working on and where they could find all that good content you put out?
We're just rolling along at Klineman, which is my CTA. That's KlinemanGroup.com for more details about that. Having a good time there. And for condor options, I've been doing a lot of research work lately, and we put out launched a new product last year called Volatility Tracker, which is a bi-monthly research product that looks at what's happening in the markets, a couple of indicators that I don't think you can find really anywhere else, not easily anyway, and a lot of commentary and some trade ideas as well based off that information. And we continue on with the Iron Condors Vol sort of newsletter that I've been publishing for a while, having a good year there too. And I think there's a lot of meat there for someone who's newer to the options market and looking to get into a little bit more sophisticated trades with someone to hold their hand. And so that's all going really well. And I'm happy to bring on anybody on board who's interested to learn more.
Yeah, Iron Condors, of course, they are the trade du jour these days, but you were very early on the Iron Condor tip, one of the first to really get involved in that space and actively talk about how to manage those on a regular basis and not just blast them out for X amount and set it and forget it like a lot of people like to do in their Iron Condors. So you were a very early mover in that space, lest anyone come to the show and think you're a Johnny-come-lately to the Iron Condor space. And also, for all of our listeners who may be scratching their heads saying, how the hell do you spell Klineman? It is Klinamen. So just search for KlinemanGroup.com. You can find out all that cool stuff Jared's been talking about here and subscribe to some of his other content because he's got a lot of cool stuff cooking and you guys should go check it out. And on behalf of Jared and of course myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to this program. I know I got a chance to meet a lot of you down there at the RMC show, which is always fun for me. It's just fun to catch up with the audience and see what you guys like about the show, what you don't like, guests you want us to bring on, topics you want us to discuss. So it's very fun. I love to get my my annual check-in with the Volatility Views audience, and I certainly got a lot of that. So we love the feedback. We love all of that stuff because it helps us make the show better. And, of course, we'll see you next time right here on Volatility Views.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.